Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. Thank you for joining us for this market update. Today is November the 8th, 2021. As you can see, I'm flying solo today. Brandon's busy with other obligations, so definitely wanted to bring this short market update to you. A couple things on the agenda today. We're going to talk about the S&P 500 and overall growth for the third quarter. It's been quite surprising, so we'll take a look at that. Secondly, we'll look at housing, how that correlates to GDP and where we think housing is going in the future. Third, we're going to talk about overall tapering. You've heard about the Federal Reserve potentially coming in and tapering the bond purchases. What does all that mean and how could that impact the market? Okay, as usual, we're going to jump right in. Let's take a look at the first chart. Right here is the summary of all the asset groups that make up the industry groups that make up the S&P 500. And what you'll see, 447 of the 500 companies have reported so far. So, very close to about 90% of the companies are reporting right now. But sales growth has accelerated 18.5% year over year, with earnings being up 41%. So again, we're in a high growth, high inflation type market right now. We consider it a cycle 2 type market, but quite impressive. Definitely has outperformed what expectations were to be for this quarter. Quite surprisingly, we think it may accelerate going into the first quarter of next year too. Fourth quarter looks like it's going to be another good one also. So quite a positive chart here. We'll continue to monitor it, but we feel this is another reason why we're bullish on the market at this point. Secondly, the next chart we want to look at is housing. Housing makes up roughly about 15 to 18% of gross domestic product, or the profits that are produced, revenue that is produced in the country on an annual basis. So when you look at this, you'll see a yellow star in the left-hand corner of this chart. Basically, currently where we stand as far as housing, we think that housing could continue to grow as far as pricing on housing and real estate, 6 to 8% per year. You look at that and you take a step back, you say, well, wait a minute, that's almost impossible with the hyperinflation we've seen in housing prices over the last year. Well, here's the thing. When you look at the chart, it says over the next 3 to 5 years, feel pretty confident that 6 to 8%, potentially double-digit growth rates could occur in real estate values. Again, we felt the same way. We felt like the market was a little bit overheated, but when we got the numbers in regards to millennials that are entering the buying cycle in regards to real estate, when you look at the overall millennial market that's entering the system, it could be roughly around 60 to 65 million new buyers entering the market. Well, the fact of it is, inventories that are all-time lows. We don't have the inventory to fill that need. So the demand of the new market coming in, being the millennials looking at real estate, could drive that 6 to 8% growth rates in appreciation for the next 3 to 5 years. We feel pretty confident that potential is on the table. So again, that represents about 15 to 18% of the GDP, or gross domestic product. So it's pretty significant that we could be seeing this type of growth going forward. That also means that the real estate prices could appreciate and continue to appreciate over and above where they're at right now. All right, last part. We talked about the Federal Reserve, and the Federal Reserve has also touched on tapering. Now, what tapering is we've been buying roughly about 120 billion mortgage-backed securities and also U.S. Treasuries on a monthly basis, basically to flood the system with liquidity. That does correlate to where we usually have a positive market in that realm. Well, you've been seeing it over the last probably year to year and a half. As the Fed has stepped in and started to print more and more money, the market has continued to go up. Now, the Fed has announced that they're going to be tapering. What that means is they're going to back it off by about 15 billion on a monthly basis from this point going into midsummer of next year, 2022. Their hopes are to get that tapering program down to zero in preparation of rate hikes that would be coming down the road. we're going to see how this impacts the economy. We're going to see how it impacts interest rates as we move forward. If inflation continues to rise, we may see interest rate increases come in before we expect them, which would be more than a year out most likely. But let's keep an eye on this. This tapering program usually correlates to the market going sideways to starting a downtrend. So we'll have to continue to monitor that. But right now, third quarter growth rates like we talked about with the S&P 500 industry groups, fantastic. So we're still bullish on the market. We're still going to be in that cycle where you've got financials, also energy, also small caps and technology looking good. And that's what's in the portfolio currently. We'll be back with some updates, but make sure to join us on social media so we can get these updates to you on a consistent basis. We'll send out other information that may be pertinent to the market at the time. So if you've got any questions, feel free to reach out to myself or Brandon. Again, Trent Bradshaw, Bradshaw Financial Planning, and Mind Your Money. Thank you for joining us.